what we're seeing is clearly a significant interest from investors in terms of adding to their equity position. Let's remember that cash mutual funds and cash positions are nearly all-time high. And what we're seeing is some of that money is being put to work in equities. Clearly, the messages that we're seeing from the economy are really supporting for a potential slowdown in terms of hiking, or definitely a pause for a prolonged period of time. The big question is that what's the impact on the economy, for how long high rates will stay and will have a potential slowdown in general on earnings, and what's the potential impact. That will have an effect on markets and clearly the investors' positioning ahead of 2024.
A lot of market participants at this point are looking wrong-footed. Some of them just did not trust this market rally that began. We haven't had confirmation around the rate story, and if you look at expectations for next year, they are wide open in terms of the size of the rate cuts, just how many and just when they start. So what does that mean in terms of positioning around major equity market trades?
So what we believe, for example, is rates, we expect 100 basis points cut in the first half of the year. So we are clearly more on the constructive side than other houses at the moment. And that will effectively, will potentially cause a move from flows from cash into fixed income first, and then from fixed income into equities on a sustainable basis. From our feedback of what investors are currently positioned, we believe in terms of equities, investors would really be willing to allocate more to equities in case of a major or a substantial correction, but clearly there is money that is being put to work. That's one of the reasons why we recently cut the total expense ratio on our S&P 500 ETF to 3 basis points, being the lowest one in Europe at the moment.
Yeah, you make this sentiment of 100 basis points by the end of, I think, the first half of next year is the note. Where does the optimism come from? I mean, yes, we're seeing it a little bit in those earnings, which seem to have bottomed out, with more than 90% having reported, 81% have already reported above estimates there as well. Is it just a case of we're calling this even ahead of a recession, where some are saying no recession could be in play, or is this just a case of things will get too tight and the Fed will have to move?
That's exactly the point. So if you think about taking the core CPI on an analyzed basis, we're trailing around 2%. With rates around 5%, the economy is effectively restricted by a net 3%, 3 percentage point. This is the highest tightening condition since 2007, 2008. And that's exactly the reason why we believe that the Fed will potentially look forward. Let's also remember it's an election year. So there's going to be a bias towards growth in the U.S. market.
You're talking about the headline being closer to the 2% mark, not the core, right?
Yes.
But the problem is the Fed's looking at the core, so it's looking at a different metric to you.
We will have to, I think, balance out. That's why I don't believe necessarily the decision has been taken. The picture is not clear. We might see a volatility around the data, especially in the first quarter of the year.
Let's move a little bit to the equity front, if I may. I mean, mega caps seem to always suck the air out of the room here. But, you know, if you were looking for opportunity in this market as we head towards the closeout of the year, where would that go? I mean, is it still in those tech? Or would something like a small cap sort of look to find some gain for you? Or is it just primarily in those bigger stocks for you?
So I think there is a case clearly for developed markets. Let's start from there. So definitely the flow that we're seeing towards global world equities, S&P 500, that's where we definitely see the vast majority of the appetite. Small cap is clearly an area of interest, considering that some of the resilience that we have seen in terms of earnings, some of those companies, and in particular the valuation gap is still pretty much interesting, both in the S&P 400 but also in the Russell 2000. US mega cap has clearly been driven by a specific number of stocks in terms of how the performance has been driven. I think the dichotomy between the NASDAQ and the S&P 500 it clearly shows that. To what extent we will prefer some level of diversification in the portfolios, I think that's clearly something that investors should definitely look at between now and the end of the year, but also going into 2024.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.